Hello everyone and welcome. Today we're going to dive deep into a topic that's super important for your exams, but let's be honest, can feel a little intimidating. India's external sector. It might seem like a lot of jargon, but trust me, by the time we're done here, you're going to feel so much more confident about these concepts. This is a really high-yield topic, so let's get right into it.
So, have you ever seen the news and wondered, why does the rupee-dollar rate keep changing? One day it's 82, the next it's 83. What is actually going on behind the scenes? It's a great question, and the answer is all about our country's economic fundamentals. By the end of this session, you'll get exactly why this happens and the huge job the RBI has in keeping our economy stable.
So how are we going to tackle this big topic? Well, we've broken it down into 4 logical pillars. We're going to start with Forex reserves, then figure out how exchange rates work. From there, we'll talk about something called currency convertibility, and then, finally, we'll wrap it all up with the balance of payments. See? Each idea builds on the last, so we're going to build our understanding block by block.
Alright, let's kick things off with Module 1 Forex Reserves. Think of this as the nation's treasure chest or our desh ka khazana, right? Just like you and I keep some savings for a rainy day, a country needs its own emergency fund. And that fund, held in foreign currencies, is absolutely crucial for our financial stability. And who manages it? Our very own central bank, the RBI.
So what are they officially? Well, they're basically assets, like foreign currencies, especially the US dollar, plus things like foreign government bonds, and of course, gold. The RBI holds on to these reserves for some really important reasons, like making international payments and keeping our currency values stable. And here's a cool fact for you. According to the IMF, India holds the 5th largest Forex reserves in the entire world. That's a pretty big deal. Now, take a look at this. This chart gives us a peek inside that treasure chest based on some 2020 data. See that huge slice of the pie? That's our foreign currency assets, or FCA, mostly held in US dollars. Then you've got a good chunk of gold, followed by 2 smaller but important parts. The reserve tranche position with the IMF and something called special drawing rights, or SDRs. And we're going to look at SDRs right now.
Okay, everyone, pens out. This is a huge exam point, so you'll want to star mark this one for sure. SDRs are a favorite question. So SDR stands for Special Drawing Rights, created by the IMF way back in 1969. Now the tricky part is, an SDR isn't a currency you can go and spend. It's more like a potential claim, a sort of voucher, on other major currencies. Its value is calculated based on a basket of 5 big ones: the US dollar, the euro, the Chinese renminbi, the Japanese yen, and the British pound. You've got to remember those 5.
So now we know what foreign currency is and how we save it, let's move on to our second module. The next logical question is, how do we decide the price or the कीमत of these foreign currencies? Well, that price is what we call the exchange rate. It's all about figuring out the value of our rupee compared to everything else.
The definition is super simple, really. An exchange rate is just the price of one country's currency in terms of another. You see it every day. If the rate is, say, 83 rupees to the dollar, it just means you need 83 of our rupees to get your hands on one single US dollar. It's this number that decides how much we pay for everything from foreign travel to imported electronics.
Now, there are basically 2 extreme ways to set this rate. On one side, you have a fixed rate system where the government just says, this is the rate and that's it. On the complete other end, you have a floating rate system where the market decides everything based on demand and supply. But India, like most countries, takes a middle path. It's called managed floating. This means the market is mostly in charge, but the RBI can step in to prevent crazy swings and bring some stability if things get too chaotic.
And this slide? It's like a mini history lesson of India's economy, and it's a very high-yield topic. Right after independence, we had a par value system where the government just fixed the rate. Then, for a long time, our rupee was pegged or tied to the US dollar. The big change came after the 1991 reforms, when we briefly had a dual-rate system. And finally, since 1993, we've been in this market-based system we just talked about. It's a fascinating journey from total control to a market-driven approach.
Let's keep building. That brings us right to our third module. We've established the rate is market-based. So, does that mean we can just convert any amount of rupees into dollars whenever we want? Are there any rules? Well, this very idea, the freedom to convert our currency, is known as currency convertibility.
In simple terms, currency convertibility is all about freedom.
It's about how easily you or I can walk into a bank with our rupees and get, say, euros or dollars in return at whatever the market rate is that day, without a whole lot of government red tape.
Now here's where it gets really interesting. The rules for converting money aren't the same for everything. It all depends on why you're converting the money. For this reason, all international transactions get sorted into two big buckets: the current account and the capital account. The current account is for all the day-to-day stuff: buying and selling goods, tourism, sending money home. The capital account is for the big long-term stuff, like investments and loans. Getting this difference is absolutely key.
So this is the crucial point you need to remember. In India, since 1994, we have full convertibility on the current account. That means if you need dollars to import goods, pay university fees abroad, or for travel, it's pretty straightforward. But, and this is a big but, we only have partial convertibility on the capital account. So, for things like making large investments abroad, there are still some restrictions and limits in place.
All right, another big one for your mains answers, guys. The Tarapur Committee. The RBI actually set up this committee twice, once in 1997 and again in 2006. Its whole job was to figure out a safe way, a roadmap, for India to move towards full capital account convertibility. Just dropping this name in an answer shows the examiner that you've really done your homework, and it can definitely fetch you some extra marks.
And that brings us to a final and biggest module, the one that ties everything we've learned together, the balance of payments, or BoP. You can think of this as the country's final balance sheet for the year, our Desh ka Hisab Kitab. It's the master document that records every single economic transaction we have with the rest of the world. All the stuff we've talked about, Forex, exchange rates, the two accounts, it all fits into this one big picture.
The textbook definition says the BoP is a systematic record of all economic transactions between residents of India and the rest of the world in a given financial year. What does that mean in simple English? Literally, every dollar that flows into India and every dollar that flows out gets noted down right here. It's our complete financial diary with the world.
Okay, pay close attention. If there's one slide you need to understand inside and out, it's this one. Seriously, if you can nail the difference between the current and capital accounts, you have basically cracked the BoP code. The current account is all about the flow of goods and services. It shows our earnings and spending right now. Think software exports or oil imports. The capital account, on the other hand, is about assets and liabilities. It shows changes in who owns what. Think a foreign company investing in India. So let's peek inside the current account. It's got two parts. First, visible trade. That's the easy stuff, physical goods you can see and touch, like cars and machines. The balance here is called the balance of trade. Then you have invisible trade. This is for everything you can't touch. Things like IT services, tourism, income from investments, and transfers like remittances sent home by Indians working abroad.
And what about the capital account? Well, this is all about the big money flows. It tracks investments, which you've heard of, like FDI and FPI. It tracks loans, like when Indian companies borrow from foreign banks. It includes banking capital, for example, the money NRIs deposit in Indian banks. And finally, any change in our Forex reserves also gets recorded here.
You hear this term all the time on the news, right? CAD, or current account deficit. It sounds complicated, but it's not. Let's go back to that family budget analogy. If your family spends more in a year than it earns, you're in a deficit. It's the exact same for a country. When our total spending on imports is more than our total earnings from exports, we have a current account deficit. And why do we care? Well, a high CAD is kind of like a warning light on the dashboard. It can pressure the rupee and make foreign investors a bit nervous. Woo! Okay, that was a lot to take in, I know. So let's just pause and do a super quick recap of the most important takeaways. These are your non-negotiables, the points you absolutely have to remember for your exams. These will help you smash most of the questions on this topic. All right, get your phones ready to take a screenshot because this is your final cheat sheet. Let's go. 1. Our Forex reserves have 4 parts: FCA, Gold, SDR, and RTP. 2. India uses a managed floating exchange rate. 3. Our rupee is fully convertible on the current account, but only partially on the capital account. 4. The BoP records everything. And 5. Remember, current account is for trade and services, capital account is for investments and loans. Got it? Great. And to finish off, I want to leave you with a question to think about. We talked about the Tarapur Committee's work. So what if India decided to go for full capital account convertibility tomorrow? What do you think would be the single biggest advantage and what would be the single biggest risk? It's a classic balancing act. अगर आपको ये वीडियो हेल्पफुल लगा हो तो प्लीज लाइक, शेयर और चैनल को सब्सक्राइब करना मत भूलना।
सारे PDF